Welcome back to the Tesla Daily News podcast for April 17th, 2026. Today, we're tracking 3 things investors actually care about right now: Tesla's custom AI chip roadmap, fresh signals on demand and pricing power, and the growing legal and reputational risks around autonomy promises. Let's get into it. Story 1. Tesla's AI chip push just hit a real milestone, and it's a stock-moving one. Here's the hook. Elon Musk says Tesla's next-generation AI5 processor has officially taped out. Context: tape out is when a chip design is finalized and sent to the foundry for manufacturing. In plain English, it's the point where you stop talking about a slide deck and start paying for silicon. For Tesla, chips are not a side quest. They're a core lever for full self-driving, the Optimus robot program, and Tesla's broader plan to be valued more like an AI platform than an automaker. Details: multiple reports say Musk confirmed the AI5 tape-out and that both Samsung and TSMC will support production. One report adds that AI6 is expected to be built on Samsung's two-nanometer process at Samsung's Texas fab, with an AI 6.5 variant on a two-nanometer node at TSMC in Arizona. The same reporting puts the AI6 contract at roughly 23 trillion won, or about $15.6 billion, running through 2033. Musk also claimed the AI6 chip could deliver roughly double the performance of AI5 at the same die size. Impact: for investors, the bullish angle is simple. Custom silicon can lower cost per unit of compute, improve performance per watt, and reduce dependence on third-party chip roadmaps. That's potentially margin accretive over time and supports the Tesla as AI thesis. But here's the counterweight. This strategy also implies heavy capital intensity and supply chain complexity. A multi-foundry approach can reduce risk, but it can also mean duplicated validation efforts, multi-node software and hardware support, and longer qualification cycles. Takeaway: the chip story helps Tesla's narrative premium. But the market is going to want proof points. When AI5 or AI6 hardware actually shows up in volume, what it costs, and how it translates into paid autonomy revenue. Story 2. Tesla stock pulled back after a huge rally, and the market is already positioning for earnings. Hook: Tesla shares dipped to around $386 after a one-day surge of roughly 7.5%. Context: Tesla is still trading like a high beta tech name. When headlines reinforce the autonomy and AI story, the stock can rip higher. When the market refocuses on deliveries, inventory, and margin pressure, you see fast profit-taking. Details: one market rep cited Tesla up about 1.3% pre-market on the day of the broader rally, while another report focused on the next day's pullback. The same reporting ties the prior rally to Tesla's spring 2026 software update, which reportedly added enhanced full self-driving features and a "Hey Grok" voice command integration. And here's the fundamental data point investors keep coming back to. Tesla's first quarter deliveries were reported at 358,023 vehicles, with production at 408,386. That's a 14% drop from the prior quarter in deliveries, and it implies inventory buildup. Energy was a bright spot in the same reporting, with 8.8 gigawatt-hours of storage deployed in the quarter. Impact: the setup into earnings is straightforward. If Tesla can show stabilization in automotive gross margin, continued energy growth, and credible timelines for Robotaxi and Optimus, the market will likely keep rewarding the AI narrative. If margins compress further or guidance softens, the stock's valuation multiple becomes harder to defend. Takeaway: watch the April 22nd earnings release for 3 specific lines: automotive gross margin, energy storage growth, and any concrete milestones on Robotaxi deployment and autonomy monetization. Story 3. Cybertruck demand is flashing warning signs, and it could hit sentiment around the auto business. Hook: data suggests nearly 1 in 5 Cybertrucks registered in the United States in the fourth quarter went to Elon Musk's other companies. Context: investors have been willing to look past softer vehicle demand because Tesla has repositioned the story toward robotics, AI, and robotics. But auto revenue and auto gross margin still pay the bills today, and a high-profile product struggling can weigh on confidence. Details: registration data reported via S&P Global Mobility shows SpaceX accounted for 1,279 of 7,071 Cybertrucks registered in the U.S. in the fourth quarter, which is a bit more than 18%. Musk-linked firms including xAI, The Boring Company, and Neuralink added another 60 vehicles. Multiple write-ups say those internal purchases likely exceed $100 million, given Cybertruck pricing around $70,000. The same coverage notes that without those Musk Empire purchases, Cybertruck registrations would have fallen about 51% in that quarter. Impact: Even if these are arm's-length transactions at market price, it's unusual for an automaker to lean on affiliated company demand to keep a plant utilized. Markets can interpret this as demand weakness, which matters for Tesla because it's still expected to grow and defend premium valuation. Takeaway. In the next earnings call, listen for how Tesla frames Cybertruck, production rate, pricing and incentives, and whether fleet sales become a larger strategy to move volume. Story 4. A new resale restriction on Model S and Model X is a signal about how Tesla wants to manage limited supply, and it has investor implications. Hook. Tesla reportedly wants at least a $50,000 penalty for buyers who try to resell certain limited signature Model S and Model X vehicles within the first year. Context. Restricting early resales is common in ultra-limited luxury products to prevent flipping and protect brand positioning. For Tesla, it also suggests the company is trying to extract maximum value from a final run of a legacy platform while it reallocates capacity toward future programs. Details. Reporting says buyers must not sell, or even attempt to sell, within 12 months without Tesla approval. If they need to sell, Tesla gets first right to buy it back at the original price minus about 25 cents per mile plus refurbishment. If an owner violates the policy, Tesla may pursue liquidated damages of $50,000 or the resale price, whichever is greater, and could restrict the buyer from purchasing Tesla vehicles in the future. Impact. This won't move revenue in a big way. But it does matter for brand control and signals Tesla's desire to manage scarcity and secondary market dynamics. It also points to Tesla's willingness to use contractual levers aggressively, which can be a reputational risk if customers feel boxed in. Takeaway. This is a small story, but it reinforces a bigger theme. Tesla is optimizing around future products and software revenue, while legacy models become more curated and less central. Story 5. Customer and legal risk around older full self-driving hardware is rising in Europe. Hook. Tesla owners in the Netherlands are angry that older models with Hardware 3 may not get promised self-driving capability. Context. This is the classic autonomy monetization risk. Tesla has historically sold FSD as a software package with expectations of future capability. If hardware limitations prevent delivery of those promises, you're looking at refunds, upgrades, lawsuits, or some combination. Details. Dutch reporting highlights a site focused on Hardware 3 claims, and a legal expert suggests the complaint could be valid if consumers were led to believe they were buying a future capability. The key point for investors is not one individual case. It's the scalability. If thousands of customers push for compensation or hardware retrofits, the cost could hit margins and create headline risk. Impact. Regulatory scrutiny and legal exposure can slow autonomy rollouts and increase compliance costs. It can also pressure Tesla to offer subsidized hardware upgrades, which is basically negative gross margin work. Takeaway. Investors should watch whether Tesla provides a clear, consistent policy for Hardware 3 vehicles, upgrade path, refund policy, and how it impacts deferred revenue and warranty or service costs. Story 6. Autonomous driving regulation in Europe is opening up, and that's a structural tailwind. Hook. Portugal has approved a legal regime to allow public road testing of autonomous vehicles. Context. Tesla's autonomy story depends on real-world deployment, not just software updates. Europe is often slower on regulation than the US, so any regulatory opening can expand Tesla's total addressable market for supervised driving systems and eventually for robotaxi operations if regulations evolve. Details. Portugal's government approved a decree law to permit autonomous vehicle testing on public roads, with licensing requirements for drivers, operators, and vehicles aimed at safety. The same coverage referenced that the Netherlands recently approved Tesla's supervised full self-driving system, described as a level 2 driver assistance system where the driver remains responsible. Impact. In the near term, this supports Tesla's data collection and brand positioning. Longer term, regulatory momentum matters for software attach rates and recurring revenue potential. Takeaway. Watch for which European countries follow the Netherlands and Portugal next, and whether Tesla can standardize a supervised autonomy feature set across the region. Alright, quick wrap. Today's big themes were Tesla's accelerating AI chip roadmap, mixed near-term fundamentals going into earnings, and real legal and demand questions around Cybertruck and older autonomy hardware. For tomorrow, keep an eye on pre-earnings positioning and any new updates on AI5 production partners, robotaxi timelines, and how Tesla addresses Hardware 3 customer claims. If you found this helpful, subscribe to the Tesla Daily News podcast and come back tomorrow for the next data-driven roundup.